So everybody, welcome to our topic today, mortgage loans for self-employed borrowers that you probably didn't even know existed. And we're giving our presentation with Robin Kozelka from ARC Lending. And Robin, if you'd like to give us a little background of your experience and what ARC Lending is all about, and just let us know how you can help us.
Yeah. Well, thank you, first of all, Bob. And the reason that Bob invited me on board is that Bob and I work together. To give you an idea, if you're not familiar with the industry, I work at a mortgage bank. So if you're going to buy a mortgage for your house, a lot of people think of only going to the bank on the corner that they're used to doing their banking with. And those banks take deposits in their traditional bank, but there's also a whole nother breed of banks that are strictly mortgage banks, and that's what we do. We do lend mortgages. We don't lend them directly to the end public. We lend them through licensed loan originators and brokers. And I apologize for not muting my phone. and like Bob. So Bob is one of our partners. So if you wanted access to our wholesale rates and our wholesale pricing, you would go through a loan officer like Bob, and Bob could help you. Bob or others like him would be able to help you get a loan. And so that's what I do. My job is to know all the loan officers, the mortgage brokers in the Bay Area, and make our products available to them. Our bank does lend all types of loans, from agency, Fannie Freddie loans to government loans like FHA and VA. We also do prime jumbo loans up to $3 million. And we also do what's called non-QM loans. And the reason that Bob wanted me to come on today is that a lot of the non-QM loans were designed specifically for self-employed borrowers. And he thought that this might be interesting to you or to people that you might care about. So he wanted me to come on and help with that. Is that a good explanation, Bob?
It is. Thank you. That's
Yeah.
perfect, Robin.
And before we start too, I would like to talk about a little bit of the benefit of working with a broker, because a lot of people don't even know that that's an option, and how do they work and how do they charge, and there's a lot of things they don't know, so they feel comfortable just going to the bank on the corner. And what I have to say is the difference between going to maybe Bank of America or Wells Fargo or Chase and to get your loan and going to a loan officer like Bob is that when you go to a licensed mortgage loan originator like Bob, you have access to not only his direct lending loans that he has, but you also have access for Bob to shop your mortgage across all of the different lenders. So any given day, one bank might have better pricing than others. Maybe that's based on the volume that they're getting, maybe other factors. But not only can Bob shop your agency and traditional loans for the best rates against these different banks, but also, those banks don't do what we call non-QM loans generally. They don't do loans for self-employed borrowers. They do, but they're going to have a very strict criteria of what you're going to have to provide. So we frequently service people that are self-employed borrowers who have gone to multiple banks and been told, no, I can't do this, or here's what you're limited to, or you're going to have to wait until next year when you refile. And Bob has some solutions that you don't have to worry about that. So he's got these solutions available to him through not only my bank, but other banks. But today we wanted to talk about what we can do specifically that can help self-employed borrowers get loans today without waiting, without changing what they write off, without waiting a year since they've changed jobs, things like that. Does anyone have any questions before we get started?
Yeah, feel free to unmute yourself. Otherwise, I'll look in the chat to see if anybody put in there as well.
Yeah.
What does the QM and non-QM stand for?
That's a great question. Non-QM, and I wish they would name it something. I like to think of it as expanded lending, right? And the QM is Fannie and Freddie, which are the two biggest agencies that they sell loans to, and they're limited by loan amount and things like that. So a lot of people in the Bay Area might not qualify for those, but so you would call those qualified. They may be limited in the Bay Area here to $765,000 loan amount, and they may have other restrictions to them. And those are the agency guidelines, so to speak. So Fannie and Freddie set these guidelines. You either qualify or you don't. So this stands for non-qualified mortgage. like I said, I like to say it's a qualified mortgage because there's a lot of very well qualified people. So sorry that and where does non-agency fit? So that's a great segue. Non-agency, there's agency loans, and this is your Fannie Freddie loans, your VA loans, your FHA loans. And then there's hard money loans. And you might know some people that had to rely on this because they had to buy something quickly, or they had some situation that they needed to get money fast. And then there's something in between, it's just called like non-QM. So, you know, some of the guidelines that we'll have will be the same as non-agency. Some will be a little broader than non-agency. And hard money will probably do things that's broader than both of us. So, so that's basically where non-agency sits. So we're not hard money, but non-QM is not agency. My wholesale bank sells both agency and non-agency, non-QM loans. We do not do hard money. So a lot of times, even though the rates for the non-QMs might be a little bit higher than the agency rates, the alternative for these borrowers might have been going to hard money, which could be literally points to buy, and also literally, it might have been points to buy, and it's 10%, you know. So that's kind of the difference there. Any questions? Okay, I won't belabor that. So non-QM is it's not just about score. It's not just about people that have bad credit. This is about various things like people that might have a difficult time documenting their income. That might be because they take they take all the allowable deductions. They've got a really good accountant. They might in the Bay Area, for example, you might be comfortable going to a 50% ratio on your property because your residual income is $15,000, and that buys plenty of Cheerios, that buys all, you know, that pays for a lot. So, you know, you might feel comfortable going a little bit higher than traditionally you may be limited to by a bank. And you might have to, if you want to be able to put that offer in, you know, in these markets where you might have 16 or more offers on the same property. My first property, there were 27 offers, and I had to bid 200,000 over asking to get that property.
Ouch.
So in those situations, you want to have that flexibility. Non-QM is also great for investors. So really this is a product that's designed for really investors and self-employed borrowers. So we have products that will help investors be able to borrow more and more easily. We also have products that help foreign borrowers. So this could be a foreign national person. This is a person that doesn't live or work in the United States, but they might want a second home or investment property in the United States. We can help them. We also have now programs for ITIN borrowers. These are borrowers that do live in the United States. They may not be US citizens, but they are paying their taxes, and they've got a international taxpayer ID number, so we can do loans for them. Non-QM might be loan size related, right? So it might be over the high balance conforming limit of 765, and in this area that's common. Or this might be the traditional thing that you might think of as non-agency products, which is they might have had a bankruptcy or foreclosure, and the seasoning on this is a lot more generous. It used to be pre-COVID, we used to do a foreclosure or bankruptcy one day out. So one day out of taking care of that foreclosure or the bankruptcy, they could go ahead and refinance. Now it's about 12 months, but that is changing daily. We're getting new guidelines coming next week. The loan to value, how much you could borrow is going up. The amount of reserves you have to show is going down. Every day these things are changing. So if it doesn't work today, someone's told you no, just keep, tell Bob or whoever you're working with, like, let's keep looking at it. Let's keep an eye out because it's changing every month as this is opening back up. We have 5 products. One's the Agency Plus. That's for if you want to do an interest-only loan, you want to do a jumbo loan. We have bank statement programs, DSCR programs, which is for investment properties, asset utilization, and foreign national and ITIN. So I'll go through each of them. So the first one is a just missed prime jumbo. So I don't know if you're familiar with this, but when you were wanting to buy a house and you want to go to a bank to get a loan on these, they may require 12, 18 months reserves. And you might also need to have a pretty low debt ratio. Maybe that's going to max out at 43. Maybe you realize that the first few years of your purchase, most of your equity is going to come from the appreciation of the property. So you want to keep the payments as low as possible for other investments. So we can do interest only. So those are the types of reasons that you would use this just miss prime jumbo. So these are loans up to 3.5 million, which in the Bay Area could look like this. In San Francisco, no, I'm kidding. I think that's $1 million house right there. Just, it's just for fun. But regardless, these loans, we can go up to 90% on a purchase or a rate and term refinance. We can take a cash out refinance. We can go up to 85%. Interest only is available. And the way that interest only works is that you would have an interest only payment for 10 years. And after that 10 years, the loan would either amortize over 30 or 40 years. So depending on what you choose, and that will make your payments a lot lower. So you're paying only interest. These loans, you don't have to pay mortgage insurance. So even if you go to 85 or 90, you don't have to pay MI. And if you factor that into the rate, it makes the rate a lot more comparable to what you would see with an agency loan. Also, if you add the interest only option, it would make the payments very similar. So if you're not quite getting there on the jumbo, this could be a solution. The debt to income ratio, like I'd mentioned before, you could go up to 50 on this, and that could really expand your purchasing power. Again, if you're buying a $2 million house, and your payments on Bob, what's a payment on a $2 million house? 20% down. What did that look like? It's kind of 15,000 or something. You're gonna have 15,000, 20,000. You're gonna have $20,000 left over after you pay that mortgage. So we're pretty confident that you can support yourself and buy, like I said, pay for all your Ubers Eats with that extra 20 grand. And then let's see what else. And also we can use, a lot of people get worried. They're like, oh, can I have both of us on the loan? My spouse had messed up and he's sloppy with his with his credit card payments, he's got a lower score. We're going to have to wait. Well, maybe not. If you make more money than that person, we can use the score of the primary wage earner, regardless of what the co-borrower's score is. So a lot of really cool things that you can do on this product that may not be available in traditional products. Any questions about these types of jumbo products?
Yeah, feel free to unmute yourself, and we're kind of a easy group to manage that way today.
Yeah. Okay, I'll move on.
Okay.
The second thing is self-employed borrowers. I want to find out who this man is and go to his shop, his coffee shop. None of my baristas look like that. But anyway, this is the product that I think for self-employed borrowers is a real lifesavers for a lot of people. And my clients, let me tell you, most of my loans are over $1 million that we do. A lot of them are anyway. And a lot of them, the people have good FICO scores, really good FICO scores, and they may be making a lot of money per month. But the problem is maybe they took, a big capital deduction in 1 year instead of, whatever it happens to be. They took too many deductions and now they're going to have to wait. This is a program that allows you to do 12 to 24 months bank statements. So how this works is easy. What you do is you provide your Bob or whoever you're working with, you provide, let's just assume it's Bob. So we're going to give Bob your 12 or 24 months of your personal or business bank statements. We would then look at deposits, we'd add them all up and we divide by 12 or 24. And then we would, if the personal bank statements, we would give you 100% credit for that income. We'd recognize that as your income. So if you had $20,000 a month going into your bank account, that's $240,000 worth of deposits for the year. We would recognize that as $20,000 a month in income. If it's a business bank statement, we want to see some expense factor out of that. So what we would do is we'd make an assumption on your expenses and we would apply that to your bank statement. So a lot of you might be self-employed in a service-based business, right? You might be a financial planner. There's a lot of, maybe an insurance agent. This could be a real estate agent. This could be if you are in a self-employed business where you're providing a service and you have no employees, it's just you, we can give you up to 80% credit. So even if you had more expenses than that, maybe you wrote off 50% of the expenses, we're going to recognize 80% of the deposit. So that's the way that it can help people qualify. And that can be done without a CPA letter. So, and on the business bank account, we look at, is it a personal or is it a business account? I'll show you how that works, but that's basically how these work. On the bank statements, these will be changing next week. We'll be able to go up to 90%, which is great for first-time home buyers. We'll be able to go to 90% soon. Right now it's limited at 85. This one, you do have a front end ratio of 40 and the back end is 50. Interest only is available, and we only count the deposits. We don't look at, well, how much is this person spending? We're not scrutinizing it to that level. We're just adding it all up. We're dividing by 12 or 24, and we're multiplying against the expense factor if it's a business account. That's it. It's pretty straightforward. It's just as easy as providing your tax returns and W-2s. It's just another form of income, and it allows you to qualify. Anyone have any questions about this or how this works?
Actually, it's a lot of detail. We're doing one this week where I had to get 24 months bank statements on lots of different bank accounts. So it does require that you have the bank statements to look at.
Yeah. But yeah, exactly. And there's other ways that we can qualify you. So if you don't qualify in bank statements, there are other ways to qualify, but well, I can skip to this one, we can do an asset utilization too. But before I go to that, we have loans also for investors. So this might be of interest to you or your clients. These are, there's something called a DSCR. Can anyone tell me if they know what a DSCR is other than Bob?
Debt service.
Net coverage ratio.
Who said that?
Herb Hoffman.
Was that Mark?
That was Herb.
Who knew it?
It was Herb Alston.
Herb, good for you, Herb. Right. So this is called debt service coverage ratio, and that's just a fancy way of saying, if you are an investor and you find a property that you know will cash flow, and you have the down payment, but maybe you just changed jobs, maybe you just maybe you're self-employed, you're starting a new company, maybe you write off too much, maybe you've got a lot of properties, too many properties, and you're at the top of what they'll lend, but you do have the down payment. We basically use the income from the property to qualify you. We don't look at any other debt you have.
Wow.
We don't look at, what's that?
I said, wow, yay.
Yay. I thought there'd be some people. Okay.
Yeah.
So we don't, all you have to have is the money. You don't have to be a landlord. We have no requirements for that. You could buy the property in an LLC if you would like. That's not a problem. You can have up to 20 finance properties, and you can finance up to 4 with us, up to $4 million. These loans go up to $2.5 million. And what we do is we look at 100% of the rent and we divide it by the income. So let's see how we calculate. Oops, no, I didn't have the calculation on this one. So the way that this one works is, let's say the rent on let's say the PITI in the property is $4,000 and the rent on the property is $4,000. Then you would qualify. You don't have to provide your job title. You don't have to provide any income documentation for yourself. You don't have to provide, we don't look at any other debt that you have. We don't care if you've co-signed for your children's student loans, and for a Maserati, it doesn't matter. Like literally, we are only looking at, does that property cover itself? And that's it. Currently, we wanted a 1-to-1 covering. So if your rent is $3,500, your PITI can go up to $3,500. PITI and HOA. So basically your housing expense has got to cover your insurance. And
That's amazing.
Yeah.
I have a question.
Sure.
I'm in Texas.
Right.
Do you guys do loans for properties in Texas?
Absolutely. Sadly, one of the only the states that we don't cover is Hawaii, because I would definitely be moving there. There's a couple of states, but Texas is definitely one of the states we lend in. So that's definitely fine. And we've got lenders in Texas and that you can work with. But this
Hey, Robin, real quick, just a real quick question back to the bank statement program. How does that affect with credit scores? Because there's a question in the chat, like Herb has a borrower that has somebody that has credit in the low 600s. Would the bank statement program work, and is it based?
Yeah. It possibly, I think, and we are having, okay, let me back up a little bit.
Not my client.
Oh, okay.
Not your client. Okay, pre-COVID.
Read the
Pre-COVID.
question.
I'm sorry.
Nothing. I was talking about.
I think pre-COVID, we went down to a 600. And just so you know that once COVID hit, all these products disappeared. We did not have these products from like late March through August. They only came back in August. When they came back in August, we were only going to 75. We were being very conservative. A lot of the things we did pre-COVID, we would not allow. And every month since August, we have expanded and expanded and expanded what we're doing. So just to give you an example, pre-COVID, we go down to a 0.75 DSCR, meaning the property could actually go negative 25% a month. We would still not look at any other income. We wouldn't look at any other debt. And if you say, hey, you're getting $750 a month in rent from the property, the payments, the PITI and HOA for the property is $1,000, you would still qualify. That's all you'd need. And actually, if you've got a little bit more, it covers up to 1.151, like over 15% cash flow, then we can even give a lower rate. So what we do now, we are in the low, I think bank statements, we can go down to a 640 or 660. Also have them contact me because I can often look at their credit report and see if there's some opportunities to improve that credit. And then also in 1 week, that answer may be different. So in 1 week, there's a good chance that we'll have a lower FICO score available. So we might go down to a 6, I don't have the matrix in front of me, but if you want to send me an email later, you're welcome to, and I can check the exact scenario and what you need to go to. Also, the amount of the credit score that you need might be dictated by how much money you put down. So if you put a little bit more down, that might be possible too. So this is a great, great loan. A lot of real estate agents don't know that this exists. And so if you know that this exists, or you know that the loans for self-employed borrowers exist, how many people does that open it up to for you to talk to? Like if I were in real estate or if I did loans, I would talk to every person that, every plumber I hired, every person I stood in line with at the post office. I would talk to everybody. And I think these are really good opportunities to go in. And also, this is a very easy loan to do. I've seen literally stacks of paper this high to do, and Bob can attest to this, to do someone that's an investor, right? They've got so many properties and they've got to show leases for every single property that they own, and they have to show all kinds of paperwork. This is a very low paperwork loan. You show me proof of what you're getting for the rent, or if it's a purchase, you have the appraiser give you the market rent for the property. And if that market rent, 100% of the market rent covers the mortgage, or probably soon 75% of the mortgage, then we can loan on it.
And actually, can you do smaller loans, like conforming loans? Like
Yeah, this is not just for jumbos. Our minimum loan size, good question. Our minimum loan size is 150,000. That is our minimum loan size. Sorry, in Texas, if that's too high. What, you're shaking your head?
Yeah, a lot of the properties I see, they're selling for 40 and 50.
Yeah.
But when
so
they're
those
remodeled,
are-
they're 200. So yeah, we ran into that a lot. We would get financed and they would charge us a much higher rate just because the principal amount was.
Yeah, because the lender doesn't make any money doing those loans, not for a while. Yeah. So fair warning on these loans, they sometimes come with a prepay, but you don't have to. You can have a no prepay loan on these, but they're going to charge you for it if you want no prepay, because the lender doesn't make any money in the loan for the first year. So, and it's certainly not when it's $40,000. So I'd say get a really good credit card with an 18, just keep on moving it. Transfer the money, get another 18 years, no interest. That's what I do. But go up market. This goes, oh, by the way, I didn't mention, we only do loans for residential properties, and a residential property is defined as 1 to 4 units. So a 5-unit property becomes commercial. So this is only referring to 1 to 4 units. So Wendy, one of the things that you might consider, it's not Wendy, I'm sorry. What was your name that you were asking questions? Sai. Yeah, Sai.
Yeah, my name is Sai.
I'm sorry, Wendy's name was right below that. So if you wanted to do, a 4-unit property, then you might get into over the 150 mark. So just look for more. So so that's pretty much what we can do on you know, flexibility of helping you build your real estate portfolio. There's another category of people, and this is pretty common here in the Bay Area. And this is, did I go too far? Why am I, how do we do this? Okay, like loans for investors, sorry. The other one is we have loans for people who have a lot of money and but not a lot of income, or income that they can't show. And these are, this could be a person that has a trust. This could be a person that has just sold their company and starting their new startup, so they're not showing a lot of revenues yet. This could be a retired person that has a pretty hefty mortgage, but and they've got a good amount of money in the bank. I had a situation with this. It was a woman in her 80s. She was on Social Security. She had about $300,000 or $400,000 in her retirement account and her bank account. She had some more money, and we were able to use the assets to help qualify her. So this is a really a good product for that. This could be used by, you know, I've had scenarios where it's a college student. They had some sort of inheritance from a grandmother or grandfather. The key on this is you have to have the money for 4 months. So I also have a friend that made a couple $1 million out of Bitcoin, right? You'd have to move that into a standard account, but we can also use that. There's a lot of room for this in the Bay Area, and this allows them to, and a lot of times too, if someone's just changed jobs, if they're a commission-based person, even in their same line of work, if you change jobs, you're not going to qualify, right? So this is going to help you because you're like, okay, I've got some money in my retirement, I can do that. So how do we do this? So basically we look at what we call qualified assets, and the qualified assets is it, depending on where you keep the money, is how much we're going to recognize of that money. So if the money is in a checking or savings account, we're going to count 100% of that money. 100% of that is qualified. If it's in a retirement account, it's either 50 or 70, depending on whether or not they're over or below, above or below 59 and a half. So if they're retirement age, we can give them 70. And if it's an investment account, because as we know, investments can fluctuate, we're going to give them 70% credit for that. So basically what we do is we divide the assets that they have, their qualified assets, by 36 months. So if you had $100,000 in assets, that would give you $2,777 a month in income. I think I made a little chart here. Here you go. And it's 100,000 is actually a little more than that. I rounded. If you had $300,000 in assets, it would give them $8,333 in income. 500 gives you close to 14,000. $1 million gives you 27,000. 2 million. So this is really handy in a lot of cases where people don't want to move their money. They're happy where it is. They don't want to put it all down. I know some people that have bought condos for 1.4 million all cash, just because they didn't think that they could have qualified. With 1.4 million, they would have had plenty of money. They could have put the minimum amount down. They could have maybe bought something more expensive, but they thought that that's all they could do because they owned a restaurant. They co-signed for some of their son's cars, and they had a lot of write-offs. So they did not think that they would qualify. And they went to three banks, and they could not get a loan, and they couldn't believe that this was possible. All they would have had to provide to me is a bank statement showing where that money is and proving to me that it's been there for 4 months. So give me 4 statements, and that's it. We do the calculation, bada bing, you're done. It's super simple.
Actually,
anyone have any questions about that?
Actually, Robin, I just want to reiterate that we are actually doing a loan just like you described. It's a $1.4 million purchase. We're only doing 20% down. We tried doing the bank statements first, but we weren't coming up as much as until we took all the assets. Instead of doing 24 months bank statements for deposits, we looked at how much money they had in aggregate. And boom, all of a sudden, we like quadrupled our monthly income based on this chart here. It was just, it's amazing that you can amortize your assets over just 3 years. Other banks that use this program will stretch it out so much longer. So if you had $1 million in the bank, you might only get $2,700 a month income. Whereas Robin's Bank, you're getting $27,000 a month qualifying income. That is huge. I have yet to see any bank that'll be that aggressive in pricing something like that to help you qualify.
And by the way, you're not going to have anything like this at a traditional bank. I mean, Fannie and Freddie has something like this, but I think it's what, 280 months or so. It's something crazy like that. Like
Yeah,
by the time you calculate it, you end up with $1,000 extra, and it doesn't help you.
exactly.
And this is beautiful too, because most banks don't allow, like I work for one of the largest non-QM lenders out there called Angel Oak, and they're wholesale. So you might not have heard of them. Your brokers will have. And with their calculations, one, you had to have 500,000. You had to have it for, now it's 6 months, but at the time we had to have it for a year. And then on top of that, you, after you did the calculations, you would come up with like less than $2,000 a month. I mean, this is considerably, and you could use that money to be added to full doc income if you wanted to supplement the income. But you could only add it to full doc income. This income source can be used to supplement bank statement income as well. So if you're out there trying to buy that really expensive house and your bank statements are not quite cutting it, because maybe not everything makes it to the bank account, this is another way to go. And believe me, I'm doing loans. These are the ones that I'm doing in the $2-3 million range. So there might be some people out there that you can, if you're a real estate agent, that you might be able to help get into homes, so this is good. Or this might be something that's an option for you or a family member. So that's, any questions about this product?
Don't be shy, anybody.
Yeah, don't be shy. I want to tell you a story too. I mean, before I go into the final product, is that I met a woman at a networking event, and I hope if she's here, she doesn't mind I tell the story, but I was talking to her and she said, oh, she had just gotten a divorce. She was used to living in a multi-million-dollar house. She had about a couple $1 million in the bank after the divorce. She was and I don't know how successful she was, but she was one of those people that have, women that have raised their children. They weren't a full-time working on their career. They're back into the job market, and she was a stylist. And so I don't know how, she's not, I don't know if she's styling for, I don't know, some, a top celebrity, but she may not be making tons and tons of income, but she's used to living in a multi-million-dollar house. So she said, I'm going to buy a house, but I have to wait a year. And I was at an event for a mortgage broker, and I said, oh, why don't you use this mortgage broker? And she's like, oh, I've got my guy, and we're going to wait a year. And I already got him. He's good. And I'm going to wait a year. And oh, by the way, I just bought an investment property in, I don't remember. It was like, I don't know, like Louisiana or something like that. It was like 150,000. And I'm like, well, how much did you put down? And she said, oh, I bought it in cash. So I knew right there from that conversation a few things. I mean, I didn't even have to ask her, but I could extrapolate probably what happened. She had a loan agent. Even if you do have a loan agent, many of the loan agents do not know about these products. They're not making themselves aware. They've got so many deals that are just flying in the box, and they don't take the time to learn about the things that might be a little more difficult. And it's a missed opportunity because they could really be helping other people, other investors, other people. And so what she ended up saying is she ended up, so I knew from the conversation that her loan agent probably told her, you write off too much. And I said, you write off a lot? She goes, yeah. And I said, well, if I had your business, I'd write off lunch or dinner with anyone that wore pants, because you're a stylist. If they wear pants, I'm writing it off. And so I imagine you have a lot of write-offs. She said, yes. And I said, in that investment property, I'm assuming she did it full cash because, and in another state, because she bought somewhere where she can invest, but then not have to worry about getting a loan because she knew she didn't qualify. So this woman was going to wait a whole year to buy a $2 million house. So what is that real estate agent doing, right? That real estate agent, because they don't have a good loan partner, is waiting a year. And how many people do you meet in a year that are real estate agents that could possibly snag you, right? So that real estate agent is waiting a year, or is in jeopardy of losing the client. The loan officer is not doing her any good. And I said, do you realize that if you had the DSCR program, you could have just put 30% down. And instead of buying a $150,000 house in St. Louis, I think it was St. Louis, you could have bought, maybe a property, maybe it's a little bit further out, but maybe you could have gone to Bakersfield or Fresno or somewhere that you could have driven to if you needed to check on your property, every 3 months. maybe instead of having $150,000 appreciating, she could have had 550,000 or $1 million appreciating in an investment property instead. And maybe instead of dealing with, tenants that are at the bottom end of, making a few $100s a month to deal with that client, instead of making thousands of dollars a month to deal with, a different type of client perhaps. So the bottom line is, she didn't get her investment property that she could have probably preferred to have, because the agent didn't know what they were doing. And then also she was waiting. And while she waited, by the way, the property values are going up and up and up. So how much money? So maybe it would have been and at that time, I could have done a non-owner, no doc, that this product on a 4-unit property and she wouldn't show a job, she wouldn't show income, we would look at other debt, and she would have paid about 3.5% on that loan. It's amazing. Now, those rates have gone up post-COVID. I hope that they're going to come back down again in the next year or so. But right now, they're a little bit higher than that. But still, that would have been amazing. And then how much did she lose on a bank statement program, on an owner-occupied property, similar type of thing? I could have gotten her something in the 3s. So maybe it's not 3 1/8 at the time, which is the traditional loans were doing that. But her property is now going to cost her, potentially, $100,000 more because she waited. So that's just one little story about, when I know that I'm talking to someone that doesn't have someone like Bob on their team.
So a couple questions in the chat, Robin. Does it work for a person who might have a cash business? For example, somebody who owns a dispensary.
Does what work? Is it bank statements, or what product are you talking about?
Well, if it's a cash business, I would probably say.
Well, I guess, what are they trying to do? Are they trying to buy a primary residence, or are they trying to buy a investment property?
Well, for that question, let's say primary residence. Let's say they work for a dispensary. They have a dispensary and they have bank accounts, but they just don't have the deposits to show.
They're not putting it. Yeah. So the only thing that they could probably do on a primary residence, we cannot use the DSCR, because when it comes to a primary residence, we have to have an ability to repay. Now, that product, you might be able to use this asset utilization. Again, this is how you would calculate it. And again, if you had a few, let's say you had a few $100,000 in a retirement account or in cash, this could be used for a dispensary, because we don't have to know what it is. Whether or not we can use income from a dispensary in California remains to be seen. Pre-COVID, we were just getting comfortable with that, because it's not legal in all states. And if you're doing banking, then the lender might not be in a state where it's legal. I know that this last election, I think 4 or 5 more states were added to the legalization. So I'd say the asset utilization would be one of the ways that they can do it. To use this DSCR product, the only criteria that we have is they cannot be a first-time home buyer. So if it's for an investment property, then we can use this product. You don't put a job down. And if it's from a primary residence, we can use this product and you don't have to put a job down. Also, if you want to call Bob and give him your scenario, let him know what you want to do. I can also ask if we're going to be okay with income from a dispensary, because a dispensary, are you selling only in California? I would assume.
I would assume, yeah, because it's all California.
And it's legal in California, so we might be okay with it. It's something that I would run by our scenario desk before you did anything. Is it a purchase or a refi? Can you see in the chat? I don't have the chat open.
No, it just said probably purchase.
Yeah. So let's talk about it. Anything, before you get discouraged on anything, bring it up to Bob, because here's the thing, Bob will hear your scenario. And even though it may not be possible today, it may be possible tomorrow, in a few months. I keep track of some things, like, for example, I was having to say no to manufactured homes, right? Or maybe in some cases, like non-warrantable condos may not be available, but now they are. And now I think soon we'll be able to do some manufactured homes. So just because it's not available this week, it doesn't mean that in 2 months or in a week from now, we can't do that. So always tell Bob. Bob will have it in the back of their mind. And trust me, when I call Bob and say, hey, guess what, Bob, we're doing this now, he'll think back through his verbal Rolodex and think, oh, who asked me about that? And he'll give you a call.
Hey,
Any
now
other
I got a question on the asset utilization. Does it work for investment properties? Did you do it for like a 1031 exchange?
Yes, we can. We can do this on investment properties, yes.
And how much would that change the parameters, like down payment, or
It doesn't, oh, that's a good question. So the way that this works is there's two flavors of this, right? So you're either going to use the asset utilization as the primary source of income, or it's going to be a supplemental source of income. So let's say, for example, they have bank statements. As long as those bank statements or that full doc income covers at least 50% of what they would owe, what would they need to qualify for that loan? So let's say you need $10,000 to qualify for a particular loan, and you've got income from your bank statements or your full doc income or your retirement income, whatever that is $5,001, right? $5,001. That means the primary source of your income is coming from that full or bank statement income. Then we would go to the LTV of that doc type. So full doc, we'd go to 90. Bank statements next week will go to 90. This week we'll go to 85. If more of the income is coming from the asset utilization or the needed income. So let's say they have $2 million in asset utilization, but they only need an extra $3,000 of that $10,000 to qualify. It's still considered the primary doc type of what's necessary, can come from your business or your bank accounts or your full doc income, then that would be. So it's a long way of saying it depends on when your primary doc type is. If your primary doc type is bank statements or full doc, you can go to 85, 90%, maybe even 90 on both come next week. If it is the primary source of income, you may be limited to 75% loan to value.
in either case, you can still combine the two, right? You can do partial asset utilization and partial bank statement.
Right, that's what I'm saying.
Yeah.
You can combine if it's only the asset utilization, it's limited to 75. But if you're combining, then we look at what proportion has to come from asset to make them qualify. And like I said, in the example, if you owed $10,000, you had to have $10,000 a month to qualify, and $5,001 comes from full doc or bank statements, then we can go to the LTV and the guidelines and the debt ratios and everything like that of the primary doc type. Does that make sense?
Yeah.
I
Robin, this, oh, go ahead. This is Valerie Diffuse. Hi, great presentation. Thank you so much for sharing all these amazing programs. So my question to you is, I wish I can put my video, but I'm up to my nose with files, so it will be messy. Okay. My question to you is, we're in Beverly Hills, do you cover Southern California?
Yeah, I can cover anywhere that you want. I could cover anywhere in the country. Okay. And if you already don't have a loan officer there, are you a loan officer or are you looking?
I was just gonna tell you about us a little bit. We are commercial real estate loan brokers. So 100% of our clients are business owners. That's the reason why I was very interested in your programs, because although we are primary commercial, these clients are reaching out to us for their primary residence or their purchases or their refinances. So having those programs at disposal, it's a great help for them. And my other question will be, what's your max? Because being in Beverly Hills, although we can go, our loans usually range from, I would say, $1 million to 300 mil. We can go down to $500,000, but lately the purchases has been around, 5 million, 6, 10. What's your max as far as those?
Well, when we say the max, that's not the max loan value, that's the max loan amount. Okay. So our max loan amount, I believe, is $3.5 million. Mm-hmm. So that may be at a lower loan to value at $3.5 million. It might be 45% down or 40% down. And our DSCR product, so that's on the bank statements or a full doc type of loan, but on the DSCR, I'm trying to go, I can't move I do this. Oh yeah, I guess I can move them here. So on this product right here, we could go to 2.5 million. On the bank statements or the, I think bank statements, we can go to 3 million loan amount, and on full doc, we can go to 3.5.
Okay. So I should pick up you anything up to 3.5.
I'm sorry?
So I should call you if I have anything up to 3.5. Over that, you wouldn't be able to help.
Yeah,
Correct?
and you know what? Always call, because there's also scenarios we might make exceptions. So for example, if you're like, hey, I'm at 25% loan to value and it's blah, 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 we might be able to do that if their loan to value is kind of lower. Other than that, but keep in mind, it's only up to 4 units. It's got to be considered residential.
Oh yeah, it is. That's the thing, is that we're doing a great job so far on the commercial, so they don't want to waste times, and they're looking for us to do their residential. And we've been doing tons of loans, purchases, refund. I mean, you've seen the rates ridiculously
Yeah.
low. So we'll be doing a lot. So these loan amounts are pretty. I mean, it's pretty wealthy neighborhood. So we're ranging in average 3 to 5 million in purchases and refinance.
Great. You're in a great area, huh?
Yeah, right. So, but do you have anybody? I mean, your programs. First of all, I'm definitely gonna reach out. I would like to do a one-on-one, so we can go through it, because
Yeah.
we have a lot of loans within your range, literally 3.5. So
Okay, good. Good.
I
Well,
just
I want those all day long. And, keep in mind, like I said, this may change, right? As things open up, as things become, as things become more stabilized after, with COVID and things like that. And we also see how these loans have been performing on, these are portfolio products that we chose to lend a certain amount, but make no mistake, even if we are lending our own money, every lender wants a loan that's sellable at the end of the day. So we are packaging these up, we're selling it off to Wall Street. And so if these products do well, and they have been, the better they do, the bigger the appetite for them is, the more we're going to expand what we're going to do. So that can change.
All right. And just to shout out to Bob, he's been amazing. He's helping me with a couple of my loans, and he's the boss. He's great.
I love Valerie. She's one of my favorites.
Yeah, and Bob may have other sources too. Just because I'm only limited to 3.5, Bob might have other sources too, because there are lenders out there that specialize in the very, very big loans. Now,
she's keeping me on my toes. You should see some of the deals she puts across.
I'm being bombarded him with loans, and he doesn't even know where to. Yeah, no, absolutely. The reason why we're brokers, so you're talking to the converted, because we love having multiple sources of lenders, and we have these loans that, obviously going through a certain type of lenders, when it's like 5, 10, 15, 20 mil. That's easy in commercial, but it doesn't seem as easy in residential. So
no. And trust me, I live in the Bay Area. I live in San Francisco, and in my neighborhood, every house around, every single family around me, we have a 2-unit that just 3 doors down from me. I'm in a 2-unit, and they bought the 2-unit. The upper unit alone is worth, $2 million. If you you build up from it a little bit, you can make it worth 3.4 just for the top unit. The bottom unit is a good $2 million. And then they're putting units in the backs of the garages, and those are 1 million just for a little unit that they built out of the back part of the garage. So it's unbelievable. Great. So that 2 units now $5 million, where I could have bought it. I could have bought it 10 years ago for probably 2 million. So it's amazing how much and it'll get better. It'll get better, and I think that it's hard in California, because a lot of times the underwriters may not be in, we have underwriters in California, but the people that are trading these, some banks, they're based out of states that are super far away, right? And they think it's a huge deal to have $1 million loan, and it's our first time home buyers are buying $1 million, so it's a different world. But yeah, we can definitely help.
Yeah, you touch on something very important. So not to monopolize the time, just last but not least, what is the do you lend on lands? Like, would you do land? Okay,
we don't do construction loans, we don't do land loans, we don't do commercial loans. Before COVID, we were doing mixed use properties. So if you had like a duplex or something that had a store underneath it, we might have done that. But honestly, this is kind of vanilla, traditional. This is going to be for your primary residences or your residential investment property.
Yeah, it was land for residents in Malibu. That's because of the fires, So, but
Yeah,
that's great.
okay.
Amazing. Thank you so much, both. And
No, please do
definitely-
reach out to me after the fact. I'd be
absolutely,
happy.
will do.
And
And
then,
then-
go ahead.
Thank you.
Yeah, and then there was another question I missed in the chat here too. So if somebody has royalty income, and as long as it shows the bank deposits, that should be useful, right? I don't
Yeah,
see
I
any
mean,
reason
you
why.
might even be able to go full doc on the royalty income, right? So, you know, definitely we could use it on bank statements, of course. But if you're doing full doc, we could use royalty income under certain circumstances. So, and keep in mind too, like we have these expanded products, but our first attempt is to get you the most prime lending option that you can get, the tightest, smallest box, because it's going to be the cheapest. But if it doesn't work, then we open it up a little bit and we go for something that might cost a tiny bit more, but it is going to get the deal done. So yeah, we're going to first try to get you to fit into the smallest box, because that's going to be the best bang price for your buck. But if that doesn't work, we've got other options.
And then I've got a private chat question. I'm trying to answer it. It seems obvious to me. So bank statement program should work for an owner that's a commission advisor, over 200,000 annual income. Home value 650, current loans only 240. They want to do a cash out refinance of 350 here in the San Francisco Bay Area. Good credit, minimal expenses. This should be an option for them, right?
This is exactly the type of loans that we do all day long. We could go up to, this is the clean slate. On a bank statement loan, you can do up to 80% cash out. Again, our guides are changing next week. They gave us a sniff of what that's going to look like, but they haven't given us. So probably next Monday, I'll probably know what it is on Friday, and I'll get it in writing on Monday. I had some changes this Friday, and we'll get those on Monday in writing. So yeah, absolutely. That sounds like something we can do now. And one thing I should mention is one of the things that we do too, which is also something that a lot of lenders don't, is over 65% loan to value. We can do cash out up to 500,000 cash in hand. But under 65% or below LTV, loan to value. And that's like the percentage of the loan that you have divided by the value of the property. So if it's 65% or lower, it's unlimited the cash out. So we're doing one right now, I think. And I think the loan's going to be probably like 903. They only owe like 100,000 on or something. So they're going to get over 800,000 cash. So that's something that not every, even non-QM lender does. So we do a lot of things that are, you know, most of the non-QM lenders don't do. And that's one of them, is we have unlimited cash out under 65%. So if you need $1 million in your hands, this is a place to get it.